Greetings, class, and welcome to this video that I'm preparing for Chapter 11. For those of you who were in the WebEx session earlier, this is not exactly taped or recorded from that WebEx session, but rather this is a separate recording because when I try to record in WebEx, we have issues with the actual video when you go to watch it. So what I've decided to do is host those WebEx sessions and then come to this recording or screen capture to talk about these concepts separately. So what you see here are the PowerPoints. We're going to go through a few of these, not all of them, but a few, and then we will go to the demonstration problems like we normally do. So Chapter 11 is about decentralized organizations, and I worked in a decentralized organization at Blue Cross. We were a very large employer in Illinois, and they had offices all over the state. And in order to make those offices work, some of the things that they did was they spread some of the accountability out by creating what we'll talk about here in a minute, as responsibility accounting. Which really what it does is it allows top management to look at the big strategy, and mid and lower level managers can respond to the needs of their particular customers, department, whatever their particular assignment is in the area where they are. There may be some disadvantages, and I've seen all of these play out in the organization where I worked. First of all, lower managers may make decisions without understanding completely the big picture. Now, there were managers who would look at, and they were not deceptive, they were not bad people, but they would make decisions and not understand how those impacted the big picture overall. And it may not have been truly harmful, but it just didn't help with the overall goal. We might have some lack of coordination. There was always this idea that if you were not in the central office and the headquarters, that you had a little more freedom, and that's what this is. You may or may not be able to coordinate as well, and there may be some problems like that. And I know this because I've experienced it. And then you see some lower level managers who may be operating with not necessarily the objectives that are shared at the top of the organization. The other thing is, and this is very true, it would be difficult, and it may be difficult, to spread innovative ideas in the organization if you have this decentralized structure. And I definitely can relate to that because we had several innovations that were developed, and they didn't always make it to every department. So here's the idea of responsibility accounting. We divide a responsibility center into three types. We either have a cost center, a profit center, or an investment center. Now, when I worked at Blue Cross, I had a cost center. Now, here they talk about a cost center as a manager who has control over cost, but not revenues or investment funds, which is true. I didn't do revenues. However, one of the important pieces in my cost center was that we had to make sure that the costs we were incurring were reimbursable under the contract that we were operating under. So if you are doing that kind of a thing, you're not just controlling costs, but you're controlling costs with the idea of making sure that they fit what the requirements are for your contract. And those requirements could change from year to year, so we had to keep an eye on those. Now, when in a profit center, well, in my cost center, for example, I had several hundred providers that I was responsible for auditing. We didn't have enough staff to do all of those as audits, but what we did have was enough staff to do some of those as audits, and then some of those as what we called a desk review, and then some of those under a third category that was kind of a blend between an audit and a desk review. But each one had a certain amount of expense that we could incur for it, and we would limit based on whatever type it was. Profit Center works differently from the cost center in that you're also generating revenues. Now, at Blue Cross, I was in the government contracts division, which meant everything we did was about that contract and getting reimbursed. In a profit center, they were basically selling um, they basically sold healthcare insurance to businesses and companies. And for example, one of the businesses we had in our contract at the time was Caterpillar, who's a very large manufacturer, not only in Illinois but around the world. And so we had a sales staff that was focused on serving Caterpillar's needs. We had basically claims departments that processed their claims and were focused on their needs. So we had a profit center in that we looked at that line of business with Caterpillar as a profit center. Now, an investment center was different. If you were looking at that, not many people in the operational side were dealing with these kind of questions. There was a treasury department, and that was smaller than the rest of us who were involved in other operations. But they basically did handle the investing activities for excess cash, and then basically for the retirement fund and for other purposes. The reason that they had an investing center is because there's a typical cycle in insurance where you begin a 3-year period with excess amount of cash. You have an increase in cash, and your costs have not caught up yet. And then by the time you get to year 3, you're going to be close to matching those up. And so what they would do is they would invest that money, prepare for what was coming in years 2 and 3 under that contract. So what we really want to talk about in Chapter 11 is this idea of return on investment and show how we can calculate it. Now, when we talk about return on investment, the idea is we have this net operating income before interest and taxes divided by average operating assets. These are assets that we put into the operations of the business. These are not investments. These are assets that are productive. So these are assets we purchase or employ to basically generate business. I'm going to skip over that slide and look at this one, understanding ROI. So here's the component pieces of return on investment that we're going to consider in Chapter 11. First, if we just look at return on investment alone, we see it as net operating income divided by average operating assets. We also have a component of return on investment, that's the margin. When we talk about margin, we're looking at the net operating income divided by sales. Now, what that means is we look at how much stuff we have to sell in order to generate that net operating income. When my father was working in the grocery business, he would talk about their margin was somewhere around 2%, which always seemed very low to me, but that was what they worked with. Now, the second part of the return on investment that we're going to look at is turnover. And turnover is really sales divided by average operating assets. This is just measuring how many sales are we generating with those assets. And really, these operating assets are what we are using to drive sales. So we want to know how much in sales we're driving for every dollar of average operating assets we employ in the business. The return on investment then is going to be the margin times the turnover. Okay. Now we'll look at that a little more in detail and apply that in the DuPont model, and this is a part of the DuPont model. But I'm not going to talk about that quite yet. We're going to look at this example of return on investment calculation. A Regal company has this following data, and they want us to know what do we have in ROI. We're going to calculate it this way: take the margin times the turnover. So the calculation works out like this: we take the net operating income of $30,000 divided by 500,000, and we have 6%. Then for the margin, we take the sales divided by average operating assets. That's 500,000 divided by 200,000, we get 2.5. When we factor those together, we have a 15% return on investment. Now, I'm not going to go through this increasing of ROI here. I just want you to get the basics of this. And also to understand that the criticism of ROI is that you may have a lack of understanding of what it is. What they talk about here is a balanced scorecard that considers other factors that go into the return on investment. If you don't understand that, then you won't understand the need to increase or how to increase return on investment. Another part to this is very true. Managers are going to inherit committed costs, and they may not have any control over those. Well, they don't often. So, for example, when we started a new audit office that I was responsible for, there was a big investment in equipment, um, in purchasing the location, and getting it ready, and all that sort of thing. And we didn't have any control over what that cost was. And then finally, we may be evaluated on return on investment, but return on investment may, if we just use that alone, it may lead to rejecting profitable opportunities. So to think about this in an expanded way, we're going to compute residual income. Now, what is residual income? It's net operating income that's left over after some minimum return on operating assets is achieved. The formula itself looks like this. Residual income is going to be equal to net operating income minus the average operating assets times the minimum rate of return. This is going to be a little different from return on investment, and residual income will measure what we have left over after we meet the minimum required return on those assets. Okay, at this point, I want to do this example, and then we're going to go to our calculations. So here is this division of Zephyr. They have operating assets of 100,000. They require a return of 20%, and in the current period, their net income is 30,000. So we're going to first calculate what the required rate of return is here. So we take 100,000 operating assets times 20% to get $20,000. Then we're going to take that average or that actual income and subtract out the minimum return to see we have residual income left over. And so if we're saying we meet that minimum required return, we're going to not only meet that, we're going to exceed that. So that illustrates a little bit of an expansion on the ROI concept. Okay, so the next thing I want to do is come over here to this document. This is in the module 10 for chapters 10 and 11, and it's a handout. But this top piece here is what I want you to focus on. This is the DuPont model. And what DuPont model does is it takes the return on investment and breaks it down into several subcomponents. It breaks it all the way back to this level. What you see is that margin is going to be driven by the income statement, and the turnover will be driven by the balance sheet. Well, it's also going to be driven by income statement factors for sales, but anyway, what we're going to do is we're going to start from this point right here in this class. We're not going back to this detail. We're going to start with net operating income and sales and average operating assets. So net income to sales gives you margin. Sales to average operating assets give you turnover. And those two multiplied together give you the return on investment. Now this is important, especially when we get to our first example today. In this first example here, I need to get back to it, we have three divisions in a business that have some of the data provided for us, but some of it's missing. And the hint that they give you here is to use the DuPont model. So we see an division, and we see the average operating assets, margin, and turnover that they provide for that one. For Beverly, we have sales and net operating income and ROI. And for Claire, we have net income, margin, and ROI. So what I'm going to do and what I've created is this Excel spreadsheet that models a DuPont formula. And if you want, you can use this to work through this as you refresh your memory with this video. So for Ann's division, or Ann division, we want to put in the information we know. Well, we don't know a net operating income or sales, but we do know the margin is 5%. We also know that turnover is 4, and that average operating assets is $1 million. So when we put that in, the average operating assets of $1 million, we know that the turnover is actually sales divided by that 1 million. In order to solve this, we can reverse that and say, okay, sales is going to be turnover times average operating assets. And that will be $4 million. And once we find that out, we can put that in up here, 4 million. And that $4 million, we know that when we're looking at margin, that net operating income divided by 4 million is going to give us 5%. So what we can do here in order to calculate net operating income is to take the $4 million times 0.05. I'm changing that to a decimal rather than working with it in percentages in Excel, but we get $200,000 here. And if you reverse the process and take 200,000 divided by 4 million, you see that's 5%. And finally, in this division, we take the 5% margin times the turnover of 4, and we get a 20, well, you can see how we do it. Take 5 times 4, get 20% return on investment. So that's the AND division. We go back to the Beverly division. We see that we have these pieces of information, but we're missing some things here. So I'm going to go back here and fill in what we know. Well, we have sales of 10,980,000, or not, no, one less zero. There we go. And then we have 10,980,000. And we have a net operating income of 878,400. Now, when we divide 878,400 by 10 million, we get a margin of 8%. If you do this mathematically here, you're going to get 0.08, and I want this to appear as 8%. So I'm just leaving it here this way. So we have 8% is the margin. And we also know for Beverly that the return on investment is 14.4. So what does that mean? Well, we want to find the turnover next. So we can actually take the return on investment divided by the margin to get our turnover of 1.8. So we know that this 10,980,000 divided by some number is going to give us 1.8. So the way to find what that number is to take that 10,980,000 and divide it by 1.8. And we get back to the average operating assets that we have here. Now, if you divide this 10,980,000 by 6,000,001, you get that turnover rate that we were looking for. The third division, Claire, we have net operating income, we have margin, we have turnover, we don't know, we have return on investment. So what we're going to do here is we're going to fill in the information we do know. So we start with $432,000. We don't know sales, but we know the margin is 7.2%. And then we come down here, and we don't know the turnover, but we know the return on investment is 14.4%. So we don't know sales or average operating assets. So in order for us to get back to sales here, we need to take the net operating income divided by the margin to get to sales. So this is 432,000 divided by some number is 7.2%. For me to get back to that, I'm going to take this 432,000 divided by 0.072, and we get $6 million. So down here we put in the $6 million dollars as sales, since we know that from here. And we want to calculate the turnover here, so we calculate that by taking the return on investment divided by the margin. We get 2. And in order to find out these operating assets, what we know is 6 million divided by the average operating assets gives you a turnover of 2. So dividing 6 million by the turnover will give you that number. Alright, so now we've completed that using the DuPont model, and that illustrates what we were talking about in the slides. Now for the next problem I want to look at, number 2, is this problem that says Kiri King Corp of Indonesia has 2 regional divisions with headquarters in Kuala Lumpur and Ipoh, and they want to know what is their return on investment using margin and turnover. So we're going to look at margin and turnover. So first, to start with, at Kuala Lumpur, the margin is going to be the 80,000 in net income divided by the 1 million in sales. Okay. When we look at turnover, we're going to look at the sales that we have, 1 million divided by the average operating assets. Okay, so simply put, I mean, we're going to divide this one by this first and this one by this second and then multiply together. Or I can do this like this. I'm going to take this divided by the 1 million and multiply the result times by this divided by the 800,000. We get 10%. For Ipoh, we're going to do the same thing. We go up here and we have the 135,000 net income for the margin, and we divide that by sales of 4,500,000. And then we take the sales of 4,500,000 and divide that by 2,250,000 to get the turnover. Now I'm going to calculate these together like I did above. I'm just going to take this 135 divided by 4,000,005, close parentheses, and multiply that by 4,000,005 divided by 2,250,000. we get a 6% return on investment. Now the second part of this is, well, what is the residual income if the minimum required rate of return is 3%? So we're going to go down here and calculate that. Now, here's how we calculated this. The $80,000 is coming from the net income we had before. The required return is going to be the assets that we have up here, average operating assets, times 0.03. When we do that math, we get 24,000. Okay, I got a couple of zeros, I'm not sure why. Different format, that's why. And then down here, we're going to do the same thing. So the required rate of return is not the required rate of return times the net income. It's the required rate of return times these assets. So we have 2,250,000 in assets. So we're going to take 2,250 times 0.03, required rate of return. When we subtract out the required rate of return for both of these, for Kuala Lumpur, we wind up with 56,000 in residual income. And for Ipoh, we have 67,500 in residual income. So that covers all the material I wanted to cover in Chapter 11. Now the next assignment that will be coming out on Wednesday will be a combination of 10 and 11. But on Wednesday I'll also prepare a video for the Foundational 15, and I will post that in Canvas as well. I'll make another announcement video coming up on Wednesday, but keep in mind that the assignments that are due on Wednesday are the Chapter 9 homework and the extra credit for Chapter 6. Also, there is a discussion this week that you need to contribute to, and it needs to be completed by April the 3rd, which is Friday. On Friday, then, what we're going to do is talk about what we're going to do for the test, and we'll prepare for the third exam. If you have any questions, feel free to send me an email or request contact. Again, I am available for office hours on Wednesdays, Thursdays, and Fridays, and I sent that message out in an announcement earlier, but I'll reiterate that here and make another announcement later this week. All right, take care, stay safe and healthy, and I hope you're doing well.